Good day. For this discussion, we will be talking about partnership formation, operations, dissolution, and liquidation. So when we say partnership, it's an association, agreement of two or more persons who contributes money, property, or industry to a common fund with the intention of dividing the profits among themselves. So it's not just about cash or land or any property that can be contributed, but as well as industry. So like for example, two single proprietorships or two business owners have agreed to come up into a single fund or a common fund to form a partnership. Accounting for partnerships should comply with the legal requirements as set forth by the partnership law, as well as complying with the partnership agreement itself. So partners should come up with an agreement before they create a partnership. All assets that can be contributed, so it may be money are in form of cash, property, or industry, are recorded by the partnership at their agreed values or fair market value if they have not agreed yet. So it would be fair market value in the absence of agreed values. Liabilities, in case, are recorded at their net present value. Thus, if a partner contributes an non-cash asset to the partnership subject to mortgage, like we have given an example of a land subject to mortgage, or land or equipment or building, contributing partner's capital is credited for the agreed value. So mortgage is a deduction to the value or fair market value of the asset that is being taken into the partnership.
Okay, what we have here. In this sample problem, give the entry to record the formation of partnership given the following information. So A and B agreed to form a partnership. A contributes a cash of 50,000 while B contributed a land with a fair market value of 50,000, and the partnership assumes a liability on the land of 25,000. So this is what we mean as partners may take into the partnership its own liability. Okay, so how are we going to record it in our book? So since we're still forming this partnership, we have a blank book of accounts. Now our entry for this contribution is we debit cash amounting to 50,000. We debit land amounting to fair market value of 50,000. We credit here, so it would look better. We will credit accounts payable for the liability, accounts payable that was assumed from the land, 25,000. Now we will record two capital account. So unlike single proprietorship that we book equity as owner's equity, here in partnership we will be keeping a separate capital accounts per partners. So A capital and B capital. Now what are you thinking of their capital accounts? So this is what we mean as here. For A, it would be as is. There's no liability. So if the asset that was taken into the partnership has associated a specific liability, then that partner will be having a net of liability capital account. Okay, so that will balance it out, 100,000, and this will be 100,000. This is to record the formation of A and B partnership. Okay, so that's it. Now, let's move on to partnership operations. Here in partnership operations, at what we have introduced, partnership is created with partners or with individuals joining together with one goal to earn, for them to divide profit, to join in a venture of where they're looking into profit, though of course it may be a loss at early stage. So there's also distribution of loss, so profit and loss distribution among partners. This can be equally, so it's as per partnership agreement. It may be equally, arbitrary ratio, or like 50-50, 60-40, so as per their agreement, or as per capital contribution ratio, so as to how much they have contributed into the partnership. Let's take into this example. During these partnership operations, we have this data given. A of capital amount 300,000, B of capital 100,000, C with a capital of 50,000. Now partners receive 5% interest on the beginning capital balances. Then partner B receives 60,000 salary. Partner C receives 10% bonus after interest and salaries. And the P&L ratios are, this is an example of arbitrary ratio. It's not equal and it's not based on the capital beginning balance. So A will receive 50%, B will receive 30%, and C will receive 20%, assuming partnership net income of 180,500. The distribution schedule would be prepared. So let's prepare a distribution schedule. Now, in a partnership, it's not just profit and loss that can be agreed. They can agree for an interest for the beginning capital balance. So it would encourage partners to take in higher capital balances at the beginning. They also can agree for a salary. Like for example, in this sample data given, partner B might be the one who is performing or rendering services. He may be the managing partner. Now, they can also agree for a bonus, like partner C is a professional partner and he can give consultancy of any time. So that's why he receives bonuses. So it really depends on how partners agree on the benefits that they can get from the partnership. And the most important is the P&L ratio. So they should agree at it at the onset of the partnership. Okay, so I have here prepared for you a schedule per partner. So here is for partner A, who contributed 300,000, partner B contributed 100,000, and partner C contributed 50,000, of which 67%, 22%, and 11% of the overall beginning balance they took in the partnership. Now, as per agreed, there's a 5% interest in the beginning balance, salary to B, which is 60,000, bonus to partner C after interest and salary, which is 10%, and the remaining distribution or remaining profit or loss will be distributed as per agreed ratio. Now let's calculate times 0.05, which is 5%, and let's sum it all up. How much is it? Okay, for letter B, he is entitled, for partner B, he is entitled for a 60,000 salary. Partner C, he is entitled for how much? 10% after interest and salaries. Now, we have 182,000 net income, right? 182,500. And let's check the running balance. Now, we have 100,000 remaining balance after interest and salaries. So, as we have agreed, C will receive 10% of the remaining balance after interest and salary times 10%. So that's 10,000. Now let's get the running balance. So that's 90,000 that they'll be distributing as per this profit ratio agreement. So 90,000, that will zero out our balance, our profit that should be distributed. We will be using what was agreed as the profit ratio, the 50, 30, and 20. So for partner C, she will be receiving 20%. Partner B will be receiving how much? 30%. Partner A will be receiving how much? 50%. Okay, let's total it all up. Okay, so here, this is just for our reference. Okay, let's lighten it up so it won't be that glaring. Okay, so the partnership distribution would show us this. Partner A will receive 60,000. Partner B will receive 92,000. Partner C will receive 30,500. That is how we will distribute the 182,500. Okay, so this is our sample problem for partnership operations. Now let's move on to partnership dissolution. So when we say partnership dissolution, it creates a new accounting entity. So it should not be confused with liquidation. When we say dissolution, it just implies that business still continues but under different ownership, whereas liquidation implies total termination of the business. Okay, now let's take a sample problem for partner dissolution. Buck and Tin are partners who shared profits and losses in the ratio of 6:4 respectively. On May 1, 2012, their respective balances were as follows. Buck capital 48,000, Tin capital 40,000, Buck withdrawal 4,000, loan to Buck 9,600, loan from Tin 12,800. On the date, Lyndon was admitted as a partner with 1/3 interest in capital and profits for an investment of 32,000. Prepare the schedule of the partner's capital. Now, in partnership dissolution, we have circumstances which will result into dissolution and not liquidation. As we have discussed, liquidation is a full termination of the business, whereas dissolution is just creating a new accounting entity, of which it's the business that still continue to operate under the new ownership. So, sample of the circumstances that would lead into dissolution is an admission of a new partner, which we have a problem here, of which Lyndon is a new partner. It may also be resulted from a withdrawal of a partner, a retirement or a death of a partner, and an incorporation of a partnership. It may also be resulted from a withdrawal of a partner, which is caused from a death or retirement of a partner, and an incorporation of a partnership. So from a partnership, they now incorporated the business, which results into a new entity, which is a corporation, no longer a partnership. But here we have a sample of an admission of a new partner. So there's a new partner who wants to take into the partnership together with Back and Tin. Now I have prepared for you a schedule of Back and Tin capital, which Back is having 48,000 capital, Tin of 40,000 capital. Now we will be disregarding some other information as it is what is needed, the balance capital of Back and Tin. Now Lyndon, as a new partner, wants to take in how much? 32,000 pesos. In exchange, let's total it all up. In exchange for a 1/3 interest in the capital. So how much is 1/3 divided by 3? That's 40,000. So in this problem, Lyndon will be entitled for a 40,000 ownership by just giving in 32,000. So that's beneficial to Lyndon. Now, it's unfair, right? Or how are we going to record this one? We have a so-called bonus method. So, in this method, we will be accounting for bonus. This is the discrepancy or difference of the amount that the new partner have taken in actual and how much he will be entitled of the partnership. Now, he is entitled for 40,000, but he will be just taking in 32,000. So what will happen to 8,000, which is lower than what Lyndon will be entitled to? This 8,000 will be bonus to the new partner. So this 8,000 will be added to Lyndon, and this will be a deduction to the old partner. So how are we going to distribute this one? Let's use the profit and loss ratio. So 8,000 for back. Back is entitled for a profit and loss ratio of 60%, right? So 8,000 times 6%, 0.60. Now, tin is entitled for how much? 40%, so 0.4. Six 50%. Oh no, sorry. This is 8, right? 8,000. And this is 8,000. Okay. So that would be a negative amount. So here, this will be in total 0. This is how bonus method works. This is adjustment. Okay, so Lyndon just paid 32,000 in exchange of 40,000 interest in the partnership, and we allocated the bonus that was received by Lyndon. We took it out from the old partners. Okay, let's show the adjusted capital balance. Adjusted capital balance. Okay, just to show you completely, adjusted capital balance will show us how much. Sorry, let me do it again. Okay, so for the adjusted capital balance, back capital is now 43,200, tin capital is now 36,800, and Lyndon capital, as agreed, is 1/3 of the partnership's interest. In reversal, it may be bonus to the old partners. So let's take an example if Lyndon was admitted as a partner but only for 10% of the partner's interest. So let's multiply 10%. This is another scenario. Okay, let's try for a 10%. 32,000 in exchange for a 10% of partnership's interest of partnership. Okay, so here adjusted capital balance of Lyndon is 12,000. Now he took in 32,000, but he will be entitled only for 12,000. What happened? There is a bonus to old partners. So now, usually this happens. This actually is what usually happens in actual. Old partners will receive bonus by taking in a new partner, especially if the business is in demand or it's growing. So a lot of businessmen are eyeing or looking into prospering partnerships. Okay, so let's distribute the 20,000 among all partners. So 14, it's 40%. For back, it's 60%. Okay, so the adjusted capital balance from 48. Now, back have 60,000, tin have 48,000 by just admitting Lyndon. And this is bonus to old partner. To old partners. Okay? Okay, now just to highlight, can you see now the difference? So this is bonus to new partner or partners in case there's two additional partner, and bonus to old partners. Now bonus to new partner is when the partner took in lower amount than what he will be entitled to. So he just took in 32,000. He gave the partnership, I'll give you 32,000. Just give me 1/3 or 30%, 33%, 1/3 of your partnership. No, it's 33. 1/3 of partnership, which we have here as our sample problem. The story of this goes as Lyndon took in or gave 32,000. Just give me 1/3 of the partnership. Now he is entitled for 40,000, of which he just gave in 32,000 to the partnership. So it's bonus to him. And the negative amount or the adjustment amount will be absorbed by the old partners. Now, in the other scenario of which Lyndon as a new partner really wanted to join in the partnership and he is willing to just be entitled of a lower amount. Now, Lyndon is willing to give 32,000 in exchange of 10% of the partnership. So how we got it? 10% of 120,000. And now he's just entitled for a 12,000. So all partners received an additional capital balances of amounting to 20,000. Okay, so can you see now the difference of bonus to new partner and bonus to old partners? That's how it's being done. Now let's move on to the other scenario of which dissolution may be caused by withdrawal of one of the partner. Like, let's kill Tin. Now we're a serial killer. Let's kill, who are we going to kill? Let's kill Tin. Okay? So Tin. Let's say this is the new partnership now. Okay? Back Tin have this capital balances. And who died? Let's kill Lyndon. Oh, the new partner died. Or just retirement. It's so horrible to kill someone in the story. Okay. Let's say Lyndon or Tin. Tin wanted to retire. He's tired and he wanted to take vacation. Now Tin, as agreed, would retire. The partners agreed to give him 50,000. So 50,000 in exchange for retirement. Tin agreed with the partners, Back and Lyndon. Now there is 2,000 increase in the capital versus the capital that Tin holds into the partnership. This, same as admission of a new partner, will be distributed to the remaining partners. So they will split it into, if the problem is silent, you can use the capital contribution ratio. It is very common. You can make use of this. Let's use it in percentage. Okay. Okay, so voila. Let's distribute the 2,000 absorption. 2,000 times 10 divided by 60. So how did I get 10 divided by 6? Oh no, 50 because it's 50. Sorry. Okay, so since the remaining partners would be Back and Lyndon, their interest will be proportioned. So negative 2,000 times 50 over 60. So he will absorb this much of amount. And no, sorry. Lyndon will absorb 10 over 60. So that's how it is. Okay. Let's sum it up. Now, Lyndon, is partner, no longer new, and this is retiring partner. That's like a bonus method in dissolution. So, in admission, there might be bonus to new or bonus to old partners. In retirement or withdrawal of a partner due to retirement or death, there's also a bonus. It's either to the living partner or to the remaining partner. So here in our sample, the remaining partners absorb, because usually, really, if someone leaves, if someone retires, it's really with our goodwill for them to leave. So we will really give them a good cut in the business, right? Okay, let's move on to partnership liquidation. This is a bit sad because this will totally liquidate or terminate the business operation. So this happens when business owners are no longer interested in the business, or there's really no chance or good chance of the business to continue. It's like they're just getting the salvage value of the business, unfortunately. Okay, so let's directly go to the sample. The following condensed balance sheet or simplified balance sheet is presented for the partnership of Sergio and Juan, who share profits and losses in the ratio of 60:40 respectively. So, as simplified, other assets were summed up 450,000 in total. Sergio loan of 20,000, so that would be receivable from Sergio. A total of 470,000, and we have accounts payable of 120,000, Sergio capital 195,000, Juan capital of 155,000, a total balance of 470,000. The partners have decided to liquidate the partnership for whatever reason they have. They agreed to liquidate it to totally terminate the business, and the other assets were sold at 515,000. So the other assets, which is just 450,000, fortunately sold at 515,000. Prepare the schedule to be distributed to the partners. Okay, now let's move on to partnership liquidation. So, in a liquidation, unfortunately, partners agreed to totally terminate the business. So, it's as their agreement based on the prevailing circumstances. They might think that the business is going nowhere, or the business is not that interests them anymore. So liquidation is a process of converting partnership assets into cash and distributing cash to creditors and partners. So creditors first. This is the rule. Whatever is liquidated or receipt from selling of the net assets, creditors are first settled, so they have the priority on any distribution. This is the very basic rule to be made by the partner until possible losses and liquidation expenses have been paid or provided for. Partners will not yet receive anything yet. So here in our sample problem, we have this condensed balance sheet statement, which is simplified as presented for partnership of Sergio and Juan, who shared profits and losses in the ratio of 60:40. So other assets of 450,000, Sergio loan 20,000. This means that Sergio took a loan, so it's a receivable of partnership from Sergio. Accounts payable of 120,000, Sergio capital of 195,000, Juan capital of 155,000, a total of 470,000. The partnerships have decided to liquidate the partnership, and the other assets were sold at 515,000. So these other assets in an actual balance sheet shows a lot of items like what can we see? Land, building, equipment which was used in the business that's no longer be used. Having the business being liquidated, so they'll be selling it all out. And partners and the creditors, of course, as prioritized before partners, will be receiving the receipt of that selling. Now, how are we going to solve this one? Okay, so I have here prepared for you the schedule as per given information. Sergio Capital have balance of 195,000 but with a loan of 20,000. So his net capital would be how much? Net capital would be 175,000. For Juan would be 155,000. That would be a total of how much would this be? 330,000. Now, as we have discussed, our receipt of 515,000 should first be applied to creditors or to third party. So the 515,000 would be taken out 120,000, which is the accounts payable to be settled, and the net receipts after settlement of creditors or third party would be 395,000. So this is the only amount that we can distribute to partners. Now, we already have determined out of it how to distribute the 330,000. How are we going to distribute the remaining, which is 65,000? So we will now refer to our profit and loss distribution, of which Juan will receive 40% times 40%, and Sergio will receive how much? 60%. So that's how we will distribute this one. Let's add up the net capital plus the adjustment. So this is what we call as the adjustment, and the final or amount to be distributed to partners, to be distributed. Okay, so after all this partnership, after we pay the creditors, after liquidating the business, we pay first to the creditors amounting to 120,000, and the remaining amount of 395,000 will be distributed to partners. Sergio will receive 214,000, Juan will receive 181,000. So that is how we will distribute here if we sum it all up. No, here we will add it all up. It's okay. Okay, if we sum these two, that would be 395. Okay, this is how we will distribute net receipts to partners. Now, there are cases where the selling will not happen one time. So it may be a lump sum liquidation or installment liquidation. In case of installment, it should be done the same way. So this will be applied first to creditors, then to partners. So it would be creditors first before partners. Okay, so that's it. Thank you.